Most traders don't know that the RVI or Relative Vigor Index indicator gives very accurate trading signals for both scalping and swing trading. But don't worry, after watching this whole video, you'll learn and master how to use the RVI indicator like the pros on Wall Street. It's a secret that has always been kept hidden, but now you can use it to your advantage just like other trading signals that are highly accurate. Perfect RVI signals are hard to come by. However, they are highly accurate and easy to recognize. That's why it's crucial for all traders to truly learn and understand this analytical technique. So, what is the Relative Vigor Index or RVI, and how does it work? The RVI indicator was introduced to traders in 2002 by a well-known developer of technical indicators and automated trading strategies named John Ehlers. This indicator compares a financial instrument's opening and closing prices that helps traders determine who is dominating the market, the bears or the bulls. The RVI is part of a group of indicators called oscillators. The formula used to calculate it is based on the concept that in a bullish market, closing prices are typically higher than opening prices, while in a bearish market, closing prices are usually lower than opening prices. The magnitude of the price change during a particular period is used to estimate the strength of the movement. Like other oscillators, the RVI indicator also helps traders identify potential overbought and oversold market conditions. When the RVI lines rise above zero and hit their peaks, it means the market is overbought. On the other hand, when both lines fall below zero and reach their lowest points, it indicates that the market is oversold. This could lead to a reversal or correction in the market. The RVI indicator is shown in a separate window below the price chart and includes two lines, RVI and signal lines. The RVI line responds more rapidly to price changes than the signal line, which is a bit slower. Trading signals for the RVI are generated when these two lines intersect. Now let's talk about the three main trading signals provided by the RVI. First, when the indicator lines cross over. This signal occurs when the RVI creates local highs and lows in the overbought region or above zero and oversold region or below zero. You should consider selling when the fast or green RVI line crosses over the slow or red signal line from above in the overbought region, as we call it the death cross. Once the reversal is verified on the price chart, you can open a selling position with the stop loss placed behind the local high. You should consider buying when the fast or green RVI line crosses over the slow or red signal line from below, which we call it a golden cross, in the oversold region following the local low. Once the reversal is verified on the price chart, you can open a buying position with the stop loss placed behind the last low. Second, when crossing the central level, if you're looking to trade using this indicator, there's one important thing to know. The indicator's central axis is at zero. When both lines cross this axis from below, it is a signal to buy. When they cross from above, it's a signal to sell. But keep it in mind, this signal alone might not be super reliable. It's best to use it together with other tools like technical analysis signals, price action patterns, or additional indicators. Let's have a quick pause here. If you're looking for those kind of things, previously I made tons of videos with bunch of useful strategies and indicators on my channel, which I'm gonna leave the link both above here and down in the description. Make sure to check them out, or you can just go to my playlist and look up for scalping/trading strategies. Third, the divergence of the RVI and the price chart. When you see a bullish divergence, it means the price chart has formed a new low that's even lower than the last one. But at the same time, the RVI low, which is made by the two indicator lines crossing, is actually higher than the previous one. This shows that the sellers are not very strong, and there may be a reversal upward soon. Once the price chart starts going up, you may open a buying position with the stop loss just a bit lower than the last low. Another quick pause here. If you don't know how to properly set your stop loss and where to put it and how to go for proper money management, risk management, how to go for proper risk to reward ratio, position sizing, winning ratio, if you want to know all about that knowledge, previously I made a video about that. Both you can check the link above here and down in the description. If you see a bearish divergence, it's when the price chart makes a new high that's higher than the last one. But the RVI high, which is made by the two indicator lines cross, is actually lower than the previous one. This shows that the buyers are not very strong anymore, and there may be a reversal downward soon. Once the price chart starts going down, you may open a selling position with the stop loss behind the last high. Here are other examples of the RVI divergence trading strategy. Thank you for watching the video until this moment. If you really like it, please hit the like button and subscribe to the channel if you haven't done it yet. And by turning on the notification bell, you're gonna be the first to be informed when I'm uploading a new video, which I'm doing on daily basis. Just like any other indicator, the RVI can sometimes give false signals. That's why using it alongside other trading tools is a good idea to make sure you don't get fooled. Since there is a risk of false signals, I'm going to share 5 trading strategies that use the RVI. Beside that, I've told you before, you can just mix it up with the other scalping and trading strategies I previously uploaded on my channel, which gone viral too, but these are the other ones, so you can mix it up however you want due to your own taste. But before that, if you're looking for a really nice platform to trade on, I highly recommend to check up on Bybit. They have the lowest fees possible. By the way, Bybit, as I'm talking to you now, is the world's second largest and reliable crypto trading platform, let's say exchange. By signing up, you have the chance to win up to $30,000 worth of prize. And by using my affiliate link down in the description, you have an extra chance of winning an extra $5,000. So what are you waiting for? Just go for it. And if you're a beginner and you don't know how to work properly with a crypto exchange, previously I made a video about it, which I'm gonna leave the link down in the description. Make sure to check it out. It's about Bybit, but it doesn't matter because more or less they're all alike. If you know how to work with one of them, you can work with the rest as well. So here are 5 trading strategies that I promised you using the RVI trading indicator. The first one is relative vigor index in the stochastic oscillator. The stochastic is a leading indicator as it gives us advanced signals before it is reflected in the price behavior. Another quick pause here. Previously, I made a completely dedicated session and video about the stochastic. If you're not familiar with the concept, make sure to check that video too. The link is down in the description. But to make it short, stochastic is a two-line indicator that oscillates between 0 and 100. If the value crosses above 80, it is considered an overbought zone, and any value below 20 is considered an oversold zone. The two lines of the indicator are labeled %K, the orange color, and the %D, the blue color. The K line is faster than the D line. The stochastic indicator provides information about momentum and trend strength. The indicator analyzes price movements and tells us how fast and how strong the price moves. The indicator shows the position of the most recent price compared to the highest and lowest price of the security over a period of time, usually 14 periods. This means that when the value of the indicator is near zero, the price is trading near or below the lowest low during the 14 period. Similarly, when the value is near 100, the price is trading near or above the highest high during the 14th period. Let me explain our trading strategy that uses two indicators: the relative vigor index or RVI and the stochastic. So here are the buying rules. First, the buy signal is generated when the price K line of the stochastic crosses above the %D line. Second, stochastic is above 50 after moving higher from the oversold zone. Third, the RVI line is above the signal line. And here are the selling rules. First, a sell signal is generated when the %K line of the stochastic crosses below the %D line. Second, the stochastic is below 50 after moving lower from the overbought zone. And lastly, the RVI line is below the signal line. This should be simple enough. The second strategy is the relative vigor index and the relative strength index or RSI trading strategy. Guess what? Another surprise. I previously made a video about RSI. If you're not familiar with the whole concept, I highly recommend to watch that video too. But to put it shortly here and talk about it, both the RSI and the RVI are oscillators, but their different qualities can help traders pick out high quality RSI trading opportunities in the market. In this strategy, the RSI focuses on trend momentum, whereas the computation of RVI seeks to relate closing prices to open prices. The RSI gives information on the strength of price movement, with positive values or above the 50 level indicating increasing momentum, whereas negative values or below the 50 level denote decreasing momentum. The RSI is the best indicator to complement or qualify the signals delivered by the RVI, especially in trending markets. Now let's take a look at two setups for the relative vigor index or RVI and the relative strength index or RSI trading strategy. For instance, in the first setup, we're looking to buy. We want to see the RSI showing a bullish condition or above the 50 level, and the RVI making a bullish cross or a golden cross. Then we can go long. In the second setup, you want to sell. Well, wait for the RSI to reach bearish territory or below 50 level, and then we'll watch for the RVI making a bearish or death cross. We can open a short position. This trading method is easy to use and very accurate for both scalping and swing trading. You can increase the accuracy of the strategy by using candlestick patterns as triggers to open positions. The third strategy in this video, I'll share a straightforward and effective scalping and swing trading strategy that combines three exponential moving averages with the relative vigor index or RVI indicator. I'll explain the strategy and provide numerous examples of where to place your take profit target, entry point, and stop loss. But before that, again, if you don't know the whole concept of moving averages, guess what? A completely dedicated video and session about that, the link is down in the description. To begin, you'll need 3 EMAs, but if you're just like me or like most of the traders out there and you're using the free version of the TradingView platform, you'll probably know so far that you cannot put more than 3 indicators in the free version. I highly recommend to go to Indicators tab and search for 10-in-1 moving averages and choose this one, which allows you to have 10 different moving averages in the same time, and it's all going to be counted as one indicator on your chart. So you can go to the setting and set it up as I tell you. You're gonna set a 20 period EMA, a 50 period EMA, and a 100 period EMA. Let's dive into the details of this strategy. The first rule with the strategy is you can buy when the 20 period EMA is above 50 and the 50 is above 100. The opposite is true for a short position. If the 20 period EMA is below 50 and the 50 is below 100, you can only take a short position. To get an entry signal, first, you need to see the price pull back into the 20 or 50 period exponential moving average. The RSI oscillator lies into the overbought or oversold areas. Then you need to see the RSI crossover that is aligning with your trend direction. That is going to be your entry signal. Now let's take a look at two setups for the relative vigor index and 3 moving averages trading strategy. For instance, in the first setup, we're looking to buy. In this chart, the 20 period EMA is above 50 and the 50 is above 100. So first, we are waiting for the pullback into the exponential moving averages and the RSI oscillator lines to reach the oversold area. Once the RSI indicator makes a bullish crossover above the center line, we can take a long position and place our stop loss below the nearest swing low or below the 50 period exponential moving average. In the second setup, we want to sell. In this chart, the 20 period EMA is below the 50 and the 50 is also below 100. So first, we're waiting for the pullback to the exponential moving averages and for the RSI oscillator lines to reach the overbought area. Once the RSI indicator makes a bearish cross below the center line, we can take a short position and place our stop loss above the nearest swing high or above the 50 period exponential moving average. The fourth trading strategy is relative vigor index or RSI and Bollinger Bands trading strategy. Let's have another quick pause here. Guess what? If you don't know the whole concept about Bollinger Bands, previously I made a completely dedicated session and broke it down. Everything you're gonna be needed plus more about Bollinger Bands, which is on its own a highly accurate trading strategy. This trading strategy involves combining the relative vigor indicator with Bollinger Bands. The Bollinger Bands indicator has a default 20 period simple moving average and 2 bands, upper and lower. Here are the rules for entering a short position using Bollinger Bands. The recommended time frame for this strategy is the daily chart. First, there should be a clear uptrend on the daily chart. Second, the price bar should close above the upper Bollinger Band line. Third, the sell signal occurs when the quick green RSI line crosses the slow red signal line from above or perform a death cross in the overbought area. After the reversal is confirmed on the price chart, you can open a selling position and put your stop loss behind the most recent swing high. To enter a long position using the RSI and Bollinger Bands strategy, follow these rules. First, check for a clear downtrend on the price chart. Second, make sure that the price bar is closed outside the lower Bollinger Band line. Third, wait for the quicker green RSI line to cross the slower red signal line from below in the oversold area, indicating a buy signal. Once the price chart confirms the reversal, you can open a buying position with the stop loss set behind the local low. Fifth and the last strategy is the relative vigor index in the MACD trading strategy. I promise this is the last time I'm bothering you with this, but this is for those people who are not familiar or let's say they are beginners or rookies in this market. If you don't know the whole concept about MACD, previously I made different videos. One of them is about the whole concept of MACD and what is it all about and came up with some strategies with it. Another one is a better MACD video, so make sure to check those videos. They make you to have a better overlook and even a trading strategy based on them. So make sure to check them out. The links are down in the description. Like the previous strategies, we'll wait for both the RSI and MACD to confirm a trade before we open a position. The MACD trade signal is a technical analysis indicator that uses moving averages to identify potential buy and sell signals because the name is telling us it's the moving averages convergence divergence. The MACD indicator is calculated by subtracting the 20 period exponential moving average from the 12 period EMA. A 9 period EMA, known as the signal line, is then plotted on top of the MACD to act as a trigger for buy and sell signals. When the MACD line crosses above the signal line, is considered a bullish signal to buy, while a cross below the signal line is considered a bearish signal to sell. Traders also look for divergences between the MACD and the price chart to spot potential trend reversals. Here are some other examples of the relative vigor index and the moving average convergence divergence, so let's say MACD trading strategy. As always, if you learned something new and if you want more videos more often, make sure to subscribe, click the notification bell, and share this video across your WhatsApp, Facebook account, or Twitter, or whatever it is to show your support. Thank you so much for watching. See you next time.